Kub is our corn and soybean market analyst this week. U.S. corn and soybean exports took a hit in December. Soybean shipments were down nearly 18% from the previous year, and corn exports were 12% lower than December 2014. China was the biggest buyer in beans, taking 60% of the overall total. Mexico was the top importer of corn. It accounted for 39% of U.S. shipments. For the calendar year, U.S. corn exports in 2015 were 10% lower than 2014, while soybean exports were 3% below the previous year. We talked with Elaine Thursday morning about the cost to move grain, the health of the U.S. economy, and recent price movements.
I want to believe that the global economy and that all of the commodities have sort of established their low, like that February 11th timeframe. There was basically every market hit some sort of a temporary low or a long-term low on that date and has been rising since then. So, I mean, when we talk about concerns about supply of a crop, we talk about a risk premium for high prices. I think what we have been experiencing in commodities, and grains have followed along, is a fear discount. So to the extent that global investors may have been selling commodities and selling markets based on that fear, maybe they were selling the rumor being concern about China demand, particularly in their manufacturing sector. They sold the rumor and hopefully they're buying the fact. So hopefully we've established some bottoms and we can continue to recover a little bit, or at least stay steady.
We'll get your thoughts on selling strategy towards the end here. Today, the USDA released its long-term projections to 2025. Anything striking in there that you saw? Well,
I thought it was a good document, again, to remind us to not panic, that the global economy is still expected to grow. China is still expected to grow, maybe not by 8 or 9 or 10% a year, but more like 5% a year. So those were the baseline assumptions that USDA made, but it still is not going to result in $7 or $8 corn for U.S. farmers. I mean, price-wise, they're looking, this is basically it. They are looking, because of this challenging profit environment, they did make some projections for lower acreage, so to go from 257 million acres for the 8 major field crops down to 250 million acres by 2017. So that's not even a pie in the sky 2025 thinking or 2060 thinking. That's fairly near term. They're expecting to see some acreage come down because of this low profitability environment.
Right, and the major declines there coming in wheat, corn, and cotton. You wrote on DTN this week about the cost to move grain. Tell me just how cheap it is.
Well, and I get trouble when I use the word cheap, because when we're talking about moving grain by rail across the country, I was reminded that the tariffs have not really fallen. It's that secondary rail freight market that has fallen. We're no longer, really scrambling to find the cars. And this is primarily a story due to lower coal movement, both within the country and outside of the country on the oceans. It's the ocean freight rate that really made headlines recently. The Baltic Dry Index, which is the index that tracks that ocean freight prices, that hit a low, again, on February 11th, kind of that critical date for these markets, based probably more on supply than demand, but also there's some fear in there too of lower demand for coal and oil and all kinds of commodities moving across the oceans.
Right. Does it allude at all to any threats of the U.S. or overall world economy?
Absolutely. Again, there's fear here. The last time that the Baltic Dry Index was even close to this low was that 2008 Great Recession. That was when global credit availability dried up. There was just nothing able to move. So you see those prices again and you really start to worry about global economic activity. And crude oil is the same way. You see crude oil below $30 a barrel and you worry, is there just no demand for energy? But in both of those cases, it's probably more related to the supply. In USDA's grain transportation report, they also emphasized the supply of capacity to ship grain. The Panamax vessel capacity has increased by 51% since 2011. So fortunately, this is probably more of a bearish supply story, which is good for grains. If we can transport it more cheaply, that makes prices more efficient both to the producers and to the end users.
We've been tracking the strength of the U.S. dollar. Tell me where it is now.
Well, fortunately, it fell through the first part of February. It had about a 5% drop in the first few weeks of February, and it has recovered since then alongside all of these other markets that have been slowly recovering since that February 11th date. So it's strong. It's much stronger than our competitors' currencies, which is unfortunate for our exports. And we do see that in those long-term projections from USDA. They're expecting the dollar to remain strong. But fortunately, it's not the major threat to commodity prices as it was even a month ago.
All right, based on what you're saying today, what do you think could be a realistic target for some sales in either corn or soybeans?
Well, a realistic target would be anything that can make you money, and I'm afraid we're probably not there, especially in environments where cost of productions are very high, like the irrigated acres in Nebraska. I mean, you look at the insurance guarantees that are being averaged through this month, it's something like $388 for corn and $887 for soybeans. That's a 2.3 to 1 ratio for soybeans over corn. Maybe soybeans don't have to bid as much because they're a lower cost to put in if you're worrying about the size of your operating loan in this year. I don't expect to see a major rally. I mean, I think I expect to see a typical spring rally, something happen sometime during the planting or growing season where we might juice these markets up a little bit. But if you reach a point where you can make money selling the grain, I think, let's not be too greedy this year.